Have you ever really paused to consider the hidden financial life of a company's biggest investments?
Mm.
We're talking about things like, a brand new state-of-the-art factory, maybe a huge logistics hub, or even the complex machinery that actually makes the products we use every day.
Right, the really big ticket items.
Exactly. And it's so much more than just, well, buying something and eventually selling it off. There's this whole really complex financial journey involved right from day one until, well, its final departure.
There's a whole life cycle.
It is. So today we're taking a deep dive into the really fascinating world of fixed asset accounting. We're specifically focusing on what's known as the acquire to retire process.
Mm.
And we'll be looking at this within the context of systems like SAP S/4HANA.
Which is what a lot of large organizations use to manage this stuff.
Right. So our mission for you today is basically to give you a clear, kind of concise shortcut to understanding how organizations manage these absolutely crucial and, let's face it, often enormous investments.
They really can be huge.
Sure. We'll guide you through the entire life cycle of an asset, from its very first appearance on the books, all the way to its final exit, and hopefully reveal the strategic why behind each step.
Yeah, and what's truly fascinating here, I think, and maybe often underestimated, is just how significant these fixed assets are. I mean, for most organizations, they represent one of the largest asset groups on their balance sheet.
Wow, okay.
And because they're so big, and because the accounting rules are, well, unique for them, they have a material effect on a company's reported financial results.
So it really matters to the bottom line.
Absolutely. Understanding this isn't just for accountants, it's essential for anyone who wants to really gauge a company's financial health, its long-term strategy, maybe even its operational efficiency.
Makes sense.
Think of fixed asset accounting almost like a vital subledger of the main financial accounting system. It's directly linked to the general ledger, so it's a critical, totally interconnected part of the entire financial picture.
Okay, so let's start at the very beginning then. What exactly is a fixed asset? How do we define that?
Right, so at its core, it's defined basically as a long-term tangible asset, property, plant, or equipment.
Uh-huh.
You hear the term PP&E a lot.
Okay.
That an organization owns and actively uses in its, day-to-day operations to generate revenue.
Okay, so things they use, not things they sell directly.
Exactly. That's the key.
Okay.
These assets aren't for direct sale to customers, and critically, they can't be easily converted into quick cash. They're long-term holdings.
Okay, so maybe give us a concrete example. Like, let's imagine a company, maybe Horizon Manufacturing. What would be a fixed asset for them?
Good idea.
Yeah.
Let's say Horizon Manufacturing just invested in a brand new, highly automated robotic assembly line.
Okay.
That assembly line is a perfect example of a tangible fixed asset. Other examples,
Right.
the land their factory sits on, the factory building itself,
Yeah.
company vehicles, maybe even the computers employees use.
Right, the physical stuff.
Mostly physical, yeah. But it's not just physical things. The category also includes intangible, long-lived assets. Think about crucial trademarks, patents, copyrights, or maybe the software licenses that run their operations.
Ah, okay. So intangible things count too if they're long-term and used for revenue.
Precisely. All of these are assets intended to generate value and contribute to the business over a significant period of time.
So if we connect this to the bigger picture, you were saying they're a huge part of the assets.
They really are. These assets aren't just numbers on a page. They're genuinely the engine of the business.
Mm-hmm.
And because they often make up a substantial portion of the total assets of a company, how they're managed profoundly impacts those critical financial statements.
Yeah.
Especially the balance sheet and the income statement.
Which is what investors look at closely.
Exactly. For investors, for analysts, the value and management of fixed assets can tell a story about a company's investment strategy, its future growth potential.
I see.
And systems like SAP S/4HANA are, well, crucial here because they provide the framework. In SAP, fixed asset accounts are linked through something called a fixed asset class to a specific general ledger account. We call this the asset reconciliation account.
Okay.
This basically ensures that every movement, every transaction related to that robotic assembly line, for instance, is accurately and consistently reflected in Horizon Manufacturing's main financial records. It's really about maintaining a single, consistent source of truth.
Right. Got it. Okay, so here's where it gets really interesting for me, the starting line of this whole acquire to retire journey, asset acquisition.
The beginning.
Yeah. When we talk about these long-lived assets, we're really talking about a company's strategic investments, right?
Yeah.
Things that are expected to provide earnings and contributions over multiple operating cycles, potentially for many, many years.
That's the key. They're not short-term expenses. They're fundamental building blocks for the business's long-term success.
So, how does our company, Horizon Manufacturing, figure out and control the true cost of that new robotic assembly line when they first get it?
Good question. So the main part, obviously, is the purchase price, what's on the invoice.
Sure.
But it also includes other direct costs, things like import duties, any non-refundable taxes they had to pay.
Okay.
Now, what if Horizon Manufacturing actually, say, produced a custom piece of equipment in-house for that assembly line?
Ah, interesting.
In that case, the production cost would form the basis for its value. And that production cost includes all the direct spending needed to get that asset ready for its intended use, making sure it's ready to be integrated and start adding value.
So you capture all those initial costs.
You have to.
Yeah.
And practically speaking, in a big system like SAP S/4HANA, we generally see three distinct methods for acquiring these long-lived assets. They reflect different real-world ways this happens.
Okay, what are they?
First, you've got external acquisition. Pretty straightforward. Assets bought directly from outside companies or suppliers, like Horizon buying that robot arm from an equipment maker.
Right. Simple purchase.
Second, there's internal acquisition. This is where the assets are actually produced by the company itself. Maybe a custom tool made in Horizon's own machine shop.
Okay, built in-house.
And finally, there's a unique category. Assets under construction, or audio.
Ah, see.
Yeah, assets under construction. These are assets that are currently being built or developed. Like imagine Horizon is constructing a whole new wing for their factory.
Ah, so it's not finished yet.
Exactly. And what's unique about IUC is that they're typically shown as a separate line item on the balance sheet while they're being built before they're actually complete and put into service. They need specific account determination set up in the system to track their costs as they accumulate.
I see. That makes sense. And for people actually using systems like SAP S/4HANA, there are tools to handle this, right?
Oh, absolutely. SAP provides very structured workflows and specific transactions. For instance, when Horizon does that external acquisition for the assembly line from a vendor, there's a specific transaction code, maybe something like F90, designed to ensure every detail is recorded precisely and the asset is logged correctly at its initial cost.
So the system guides you to capture it correctly from the start.
Right. It's all about ensuring accuracy right from that very first financial entry.
Okay, so the robotic assembly line has been acquired, costs are figured out. What's the critical next stage? You mentioned something. Capitalization. That sounds important, maybe a bit tricky.
It is really important, and yeah, it can seem tricky, but the concept is fundamental. Capitalization is basically the process of recording a cost as an asset on the balance sheet, rather than treating it as an immediate expense that just hits your profit and loss statement straight away.
Okay, so instead of saying we spent X amount this month, you say we now own an asset worth X amount.
Precisely, and the implications go way beyond just the accounting entries. Well, let's stick with Horizon Manufacturing's assembly line. Imagine it has an estimated useful life of, say, 8 years.
Okay.
If Horizon were to expense the entire purchase price in the first year they bought it.
Their profit for that year would look terrible.
Exactly. It would immediately make the company seem far less profitable, maybe even show a huge loss, just because of how they book that one asset. Capitalization avoids that distortion. It allows them to expense only a portion, say, 1/8 of its cost each year over those 8 years.
Spreading the cost over the time it generates value.
That's the idea. But even more profoundly, smart investors and analysts, they really scrutinize a company's capitalization policies
Why is that?
because it reveals something about their strategic thinking. Are they just focused on immediate short-term gains? Or are they building for the future, recognizing the long-term value these assets will generate? It tells you a lot about their capital allocation strategy.
Ah, that's a really interesting angle. So it's not just bookkeeping, it's strategy.
Absolutely. And this leads us to understand those two key stages in an asset's life that are most relevant for financial accounting. That under construction, or IUC phase we mentioned,
Right, while it's being built.
and the productive life, or final asset phase. Capitalization in this context specifically means posting all those relevant accumulated costs to the IUC account first. Then, Once the construction of, say, Horizon's new factory wing is totally complete, you settle or reclassify this total amount from all you see to a final prominent asset class, maybe buildings.
Okay, so it moves from being built to ready to use in the books.
Exactly. That move formally recognizes the asset is ready for use, and it can start its productive life and, crucially, start being depreciated.
And again, I assume systems like SAP S/4HANA have ways to manage this capitalization step depending on how it happened.
Yes, definitely. So for instance, if Horizon acquired that assembly line directly from a vendor, there are specific SAP transactions, maybe that F90 again, that can effectively capitalize the asset while simultaneously creating the accounts payable entry to the vendor.
Ah, so it does both at once.
It can, yeah. But there are other transactions too. Some let you capitalize the asset value with an offsetting entry straight to a general ledger account. That might be useful for prepaid purchases where you don't need a vendor invoice right away, or you might use a clearing account.
So different tools for different situations.
Right. The main point is the system provides mechanisms to ensure the accounting perfectly matches the real-world acquisition event, no matter the specifics.
Okay. So Horizon's assembly line is acquired, it's capitalized, it's now in active use, humming away making things. What happens during this phase? You mentioned depreciation earlier.
Right. So once it's capitalized and in use, we enter the realm of depreciation for tangible assets, like the assembly line, and amortization for intangible assets, like a patent or software license.
Okay. Depreciation and amortization. Similar concepts.
Very similar. Essentially, they both represent the regular systematic allocation of an asset's cost over its estimated useful life. It's the accounting method to spread that initial cost over the period during which the asset is expected to provide economic benefits.
Like you said, spreading it out, like my car losing value over time.
Exactly like your car example. It loses value, but you account for that systematically over its driving life. You don't just write off the whole car on day one. That wouldn't reflect reality.
Makes sense. So what's the fundamental purpose behind depreciation? Why do companies have to do it?
Well, fundamentally, it serves two main functions. First, it's for asset devaluation. That means systematically reducing the asset's reported value on the books over its usage time, reflecting its wear and tear or obsolescence.
Okay, showing it's worth less over time.
And second, maybe more importantly from an accounting theory perspective, it's to allocate the cost of an asset over its expected useful life to the periods that actually benefit from its use. Matching principle, essentially.
Matching the cost to the revenue it helps generate.
Precisely. It's seen as balancing the constant use of the asset with the financial benefits, the revenue it helps generate, and it's absolutely crucial for calculating the asset's net book value.
Net book value.
Yeah, that's its original cost minus all the accumulated depreciation taken so far. That net book value is critical, especially during financial closing periods like month-end and year-end. Without depreciation, Horizon Manufacturing's balance sheet wouldn't accurately show the true remaining value of their assembly line, and their income statement wouldn't reflect the true cost of using that asset each period.
Got it. So it impacts both the balance sheet and the P&L.
Directly.
Now, is there just one way to calculate depreciation? Or are there options?
Oh, there are definitely options. Companies use various methods, often trying to match the cost allocation pattern with how the asset actually generates economic benefits.
Okay.
The main and probably most common methods include, first, straight-line depreciation. Super common, very simple. Like you said, cutting a cake into equal slices. You allocate the exact same expense amount every single year over the asset's life.
Okay, predictable.
Very. Then there's the double declining balance method. This is an accelerated method. It calculates a higher depreciation expense in the earlier years of the asset's life.
Why would you do that?
The logic is that assets, like maybe Horizon's new assembly line, are often more productive or efficient when they're new, so you recognize more of the cost earlier.
Ah, okay. More expense when it's doing more work, kind of.
Sorta, yeah. Then we also have the units of production method. This one's different because it's based on usage, not time. Depreciation is calculated based on the total number of units produced or the number of hours the asset is actually used over its life.
So if you don't use it much one year, the depreciation is lower.
Exactly. It ties the expense directly to the output or usage.
Interesting. Any others?
One more common one is the sum of years digits method. It's another accelerated method, a bit more complex to calculate perhaps, but it also front-loads the expense, recognizing a higher amount in the early years and less in the later years. Similar in outcome to double declining balance, but calculated differently.
Wow, okay. So companies choose the method that best fits the asset and how they use it.
That's the goal. Each method has its strategic purpose, aiming to give the most accurate financial picture for different types of assets and usage patterns.
Right. Okay, so time marches on. Even state-of-the-art robotic assembly lines eventually, come to the end of their useful life, or maybe they're just not needed anymore. What happens then?
Yeah, all good things. So when an asset like Horizon's assembly line has run its course, we get to the final stage, retirement, or sometimes called scrapping.
Retirement sounds nicer than scrapping.
Huh, maybe. But essentially, it refers to the process of eliminating assets from the accounting records. You're effectively removing them from the balance sheet. The technical term is derecognition.
Okay, taking it off the books. Why would an asset get retired?
Well, there are several common reasons an asset might become obsolete or just ready for retirement. It could simply be a consequence of physical depreciation. It's just worn out, broken down, no longer efficient.
Makes sense.
Or maybe it's the result of rapid technological innovation. A newer, better machine comes along, making the older one redundant, even if it still physically works.
Technology moves fast.
It does. Sometimes, an asset has already been fully depreciated over its planned useful life. Its cost is fully allocated, even if it's, still technically functional.
So its book value is zero or close to it.
Could be. Alternatively, it might reach the end of its useful life, but still have some residual salvage or resale value, meaning you can actually sell it for parts or scrap metal or something.
Ah, so get some cash back.
Potentially, yes. In other cases, it might be only partially depreciated, still have some book value left, but maybe has resale value, or maybe, sadly, is partially depreciated but has absolutely no remaining value to resell. In that case, scrapping might be the only option.
Okay. And you mentioned residual salvage value. What exactly is that again?
Right. So that residual or salvage value is the estimated resale value expected right at the very end of the fixed asset's planned useful life. This estimate is actually factored into the depreciation calculation from the start.
Oh, so it affects how much you depreciate each year.
It does. It helps determine how much of the asset's total cost needs to be depreciated over its life. Although, interestingly, for simplicity, it's often assumed to be zero in many calculations, especially for assets where the end value is likely negligible or hard to predict.
I see. Okay, so when Horizon Manufacturing decides to retire that assembly line, how does the type of retirement affect the accounting?
Ah, good question. The how matters. For example, if the assembly line is actually sold, and that sale results in revenue, maybe even a profit if they sell it for more than its current book value,
Uh-huh.
this can be posted directly with the customer who bought it, generating an accounts receivable, or maybe posted against a general ledger clearing account first.
Okay, so booking the sale.
Right. Alternatively, the asset might just be scrapped. Maybe it's obsolete, damaged beyond repair. In this case, obviously, no revenue is earned from its disposal. It's just gone.
A pure write-off.
Pretty much.
Yeah.
Or another scenario, maybe Horizon decides to transfer it to a subsidiary, another company within the same group. That's usually handled using a specific manual posting function for what's called an intercompany asset transfer or retirement.
Okay, different processes for different endings.
Definitely. But what's absolutely critical to understand, regardless of the specific circumstances, sale, scrap, transfer, is that the asset's original purchase cost and all the historical accumulated depreciation value must be removed from the fixed asset accounts.
Wiping its history clean from the active asset.
Exactly. And then any difference between the asset's current net of book value, cost minus accumulated depreciation, and any cash or value regained through the disposal, whether that results in a profit or a loss on disposal, must be accurately recorded as either income or expense in that period.
So the books have to perfectly reflect the financial outcome of getting rid of the asset.
Perfectly. Ensures Horizon's books show the true impact of that asset's final departure.
And I bet systems like SAP S have specific ways to handle these different retirement scenarios too.
Oh, absolutely. That's another area where robust systems are indispensable. They provide dedicated tools and structured transactions. For instance, if Horizon sells that assembly line to an external customer, there's likely a specific transaction, maybe something like F92 in SAP, that would automatically generate the necessary accounts receivable invoice and credit the asset accounts, ensuring proper derecognition.
Automating the complexity?
Trying to, yes. Similarly, there are distinct controlled processes for scrapping an asset with no value or for handling those intercompany transfers. The system's role is to ensure that this complex task of removing an asset from the books is handled accurately, compliantly, and consistently every single time.
Okay. Wow. So stepping back, what does this all mean for, for you listening? We've journeyed through this really complex yet absolutely vital acquire to retire process for fixed assets. We followed Horizon Manufacturing's imaginary robotic assembly line from its initial purchase, that crucial step of capitalization,
Spreading the cost,
through its working life, where depreciation meticulously allocates that cost over time.
reflecting its use.
And finally, to its retirement, its removal from the books. Each step, meticulously managed, isn't just some accounting entry. It genuinely underpins a company's true financial standing. It profoundly impacts the balance sheet, the income statement, and the overall reported profitability and long-term view of the company.
It really does, and maybe this raises a more strategic question. How does this detailed understanding of managing fixed assets actually connect to the broader picture of business strategy and decision-making?
Yeah, how does knowing all this help Horizon Manufacturing run better?
Well, meticulously tracking an asset's life cycle, really knowing its true cost, its current depreciated value, its potential end-of-life options, it truly empowers companies like Horizon to make better long-term investment decisions.
Better planning.
Better planning, optimizing resource use, understanding their true operational costs much more accurately, and ultimately, planning better for the future. It's not just a task for the accounting department, it's actually a strategic advantage. It drives capital allocation, operational efficiency, and ideally, sustained profitability.
That's a great perspective. It connects the detailed accounting back to big picture strategy.
Exactly.
So maybe a final thought for you, our listener. Consider the inherent challenge today of predicting the useful life of an asset in our, incredibly rapidly changing world.
That's a tough one.
It is. If technological innovation or maybe unforeseen market shifts can cause an asset, maybe even Horizon's fancy robot, to become obsolete much faster than they originally anticipated, well, how might companies adapt their acquire to retire strategies? How do they mitigate the significant risks of having prematurely depreciated or maybe suddenly valueless assets on their books?
The constant balancing act.
It really is. It's a dynamic puzzle with very real financial consequences that pretty much all businesses face today. So we invite you to maybe look at the world around you a little differently now. The next time you see a major piece of infrastructure, a bridge, a building, or a company vehicle driving by, or even think about a widely recognized brand name and the assets behind it, take a moment. Consider the invisible, complex, acquire-to-retire journey that asset is on right now.
That financial dance happening behind the scenes.
Exactly. This intricate financial dance is happening all around us all the time, shaping the companies that, shape our world.